All right, looks like some names are trickling in. Well, welcome. My name is Matt Price. We will be talking retirement planning timeline this morning. So good morning from Houston. Hope everyone is well. We're getting, I think, a little more rain this afternoon, it looks like, out the window. So let's jump in. Our promise trains will run on time, and 30, maybe 40 minutes of material to cover. Please do this. Ask questions along the way. If you have a personal question, shoot us an email. Happy to speak offline about any topics that might be of interest. Who are we? We are the Price Group. That is Randy. I am Matt. He'll try to tell you he's my older brother, but he's actually my father. We follow a fiduciary standard. Retirement is really all we do. 80+% of our clients are retired. We think that's really important as you are kicking the tires and approaching retirement. You want someone that's a bona fide specialist in the area. So quite a few years of experience. I've been with Randy for 12, almost 13 years. A few accolades that Randy and I have received from Forbes. Randy's had a few by Barron's, Financial Times. We're both certified financial planners. We are also certified investment management analysts. So we think that is an important consideration. We went to Wharton School of Business to get our CIMA, which we think is also an important credential in our industry. A little bit about our firm, Steward Partners. It's actually based off the biblical definition of stewardship. We're not owned by a bank. Our firm, when we provide advice to advisory clients, is a fiduciary. Raymond James is one of our two custodians. The other one is actually Pershing. Most of our clients use Raymond James. It's been a great relationship for clients, and they have good statements, but we can talk about that in more detail if it is of interest. So today on the agenda, we'll talk about what does retirement planning look like 2 to 5 years out? What does it look like less than 1 year out? And then what does it look like after retirement? So let's jump in 2 to 5 years out. The old saying, look before you leap. We think it is vitally important to create a wealth plan for retirement. This is maybe seems intuitive, but a lot of people that we meet for the first time, they have a plan up here, but they haven't written it down. And we don't think if a plan's written down, we don't think it's actually a plan. We talk a whole lot about in our process developing what we call the family index number. What rate of return does your family need to be, quote, successful over a long period of time? Evaluating contributions, allocations. Should we add money to a Roth? Should we add money to the pre-tax account? Considering the consequences of a negative year in the stock market is a big deal. The closer you get, the less time you have to recover from a market downturn. And we think it's prudent advice to consider hiring a qualified advisor who specializes in retirement planning. So looking here, this is a little bit of a busy slide. Is your spreadsheet adequate for retirement? And what we're looking at here, there's 4 boxes. The 2 on the left represent the accumulation phase. So that's while you're still working. And the 2 boxes on the right represent the retirement phase, or we call it the distribution phase. And we were showing here 10 years, you're starting with $100,000. In that top left box, you actually have a negative 15% rate of return, 7% rate of return in years 2 through 9. And then that last year, in year 10, you have a positive 29% rate of return. You start with 100,000, and in that top left box, you end up with round numbers 188,000. Now, what happens if you flip the order of those returns? You get a good year in year 1, the bottom left-hand box, you get a good year in year 1, same returns in years 2 through 9, and a poor year in the last year, year 10. What you can see on the 2 left-hand side boxes is you actually end up with the same amount of money. So the point we're trying to make is while you're still working, the order in which you get your returns, it doesn't matter. Now, if we flip over to the two boxes on the right-hand side, the distribution phase or retirement, the order of which you get your returns, it matters a whole lot. And so starting with a negative return, what you can see is you run out of money somewhere between years 9 and 10. However, in the bottom right-hand box, if you have that good return in the first year, the poor return in the last year, you end up with $52,000, $53,000 at the end of the 10th year. So in retirement, the sequence of returns matters a whole lot. We would argue that a spreadsheet with a static rate of return, it can work well while you are still employed, not taking money out of a retirement portfolio, but it's not prudent advice to use that for retirement planning. We think you need more than just an investment guy. You need a wealth coach. One of our favorite quotes by Mr. Benjamin Graham, who is one of Warren Buffett's mentors: the best way to measure your investing success is not whether you're beating the market, but whether you've put in place a financial plan and behavioral discipline that are likely to get you where you want to go. So that's we think that is a holistic way to look at retirement planning. That's really what a lot of what we base our practice on, is we want to help clients put in place a financial plan and create behavioral discipline, not for if, but when markets do get choppy. So what should a retirement plan include? We don't look at retirement as an event. We think it's an ongoing process, but we think a retirement roadmap should help us answer the questions: how much can you spend? How long will your money last? What rate of return do you need? And we're a little bit cheesy, but we call our Live Well plan, our retirement plan, our Live Well plan. Just from a standpoint, most all clients really do want to live well in retirement. So that's been the name for quite a few years. But a big part of that, I mentioned it earlier, developing a family index number. Our goal, unless you tell us otherwise, is we want to take the least amount of risk possible for you to be successful. And so we're trying to figure out what rate of return do you actually need. So this is not a cookie cutter number where everyone has the same number. This is peculiar to your family based on your goals, your needs, your objectives, and something that we put together in fine detail within the Live Well plan. So what we try to do is we try to add a few tangible ideas in presentations like this. One of them is a way to get money into a Roth IRA if you exceed the income threshold. And so this might be a little bit dense. If you have any questions on this, please follow up. But what we can do is we can contribute to a traditional IRA. If you're above the limits, that number, it will be a non-deductible contribution. And so let's say you put in $6,000, just to use a figure. You do that on a Monday. The next day, you convert that traditional IRA to a Roth IRA. Now, only the gain, and in this case, if you just held cash and it was in there for one day, you would have no gain. Only the gain would be treated as ordinary income because that non-deductible IRA contribution came from after-tax dollars or dollars that you've already paid tax on. And so you can convert those dollars from a traditional IRA to a Roth IRA. The place to watch out where you could stub your toe is what we call the pro rata rule. So it's typically not as generous of a strategy if you have other pre-existing IRA dollars. Now, there's a salient difference between IRA dollars and 401k dollars. But if there are other IRA dollars, they will force you to pay tax on the portion of which is taxable. So this makes a lot of sense if you don't have any other IRAs that are pre-tax. But once again, something good to check with us offline on your personal situation, consult with your CPA before doing any type of planning of this nature. The second idea maybe is the first cousin of what we just talked about, but a lot of 401k plans have a third bucket, so not a pre-tax bucket, a Roth bucket, but what we call an after-tax bucket of money, where you don't get a deduction. It doesn't reduce your gross income when you add monies to the after-tax bucket. But a lot of these 401k plans will allow you to roll your after-tax contributions. Big difference there with the contribution versus the gain. But you can roll the contributions into a Roth IRA. Some plans allow it up to one time a year. So that is, those would be kind of our two just off the cuff, planning 2 to 5 years out, some tangible ideas for consideration. So looking at your investment risk budget, once again, we think this is something good to do 2 to 5 years out. What would a 25% correction do to your retirement portfolio? And a lot goes into that. It depends on what type of stocks you own. It depends on, are you going to need to take principal from your retirement portfolio, or are you just taking income? Do you own more than 10% of your company stock or any one stock in your portfolio? The closer you get, like I said earlier, the more we need to really pay attention to that risk budget, just from a standpoint. When you're in your 30s or your 40s and you have a pullback, you say, it's not a big deal. But having a pullback really close to retirement, it could create a situation where you may need to work a year longer, which a lot of people tell us, I've thrown in the towel, I'm done, I don't want to do that. So we think this is prudent advice, 2 to 5 years out. And the last thing here before we move over to planning within 1 year is consider hiring an advisor. You can see here the 20-year annualized returns for REITs, high yield bonds, the overall stock market, and then in red there, the average investor. Easy to point out that the average investor has underperformed over a long period of time. These numbers are updated on an annual basis, but the numbers really don't change a whole lot. They're typically pretty similar in the output. But what an advisor can do, help reduce emotions when investing, reduce stress. Sometimes you have more options to alternative investments, individual bonds, other strategies to produce additional income. So we think maybe you're not a candidate to hire someone. We think everyone should be a candidate to at least kick the tires and talk to an advisor and find out more if it could be a good fit for your family. So let's look at retirement planning less than 1 year out. Here would be, I'd consider this a summary page of everything that we want to do less than 1 year out. We want to look at what income are you going to need in retirement? Are we taking the company pension versus the lump sum? Are you below 59.5 or over 59.5? How are we going to create income on a monthly basis in retirement? The discount rate for your pension plan is obviously a big deal, and evaluate the ordinary income. So there's a lot of tax planning, typically the last year of employment, that first year of retirement, depending on the month of which you do retire, and then hiring the advisor if you haven't already done so. A good rule of thumb is 70-80% of your final year's salary is what you would need in retirement. And this is not, the general rule of thumb doesn't necessarily apply to all people. So we see that number actually higher for some families, less for some families. I'll say this, we have a pretty good, I call it the sniff test of us looking at just hundreds of different families going through this process. We can pick up pretty quick on and give a good guess on what families typically spend on a year-over-year basis. So this is a real important figure on when we're doing retirement planning. How much are we going to spend? And, inflation in retirement is a hidden tax. Randy likes to joke and say the bank of mom and dad is always open. But big ticket items like a kitchen remodel, a roof repair, whatever it might be, travel, are your expenses fixed or variable? And then we love generous clients and the charitable giving, whether it's to a specific charity or to family members. Trying to optimize that is one of the things we really enjoy doing with clients. So as we hone in on how much money do we take out from the portfolio for retirement, where do we take it from? A catchy phrase that's been used over the past few years is 3% the new 4%. And you can see here over a long period of time, taking out 4% from your portfolio, including inflation, assuming you're balanced, your portfolio goes down a little, up a little, you end up over this 20-year period from, call it 2000 to the end of 2021, just with about what you started with. There's some evidence to suggest that 3% would be a more palatable distribution rate, given the fact that interest rates, even though rates are high today compared to the last few years, they're still not as high as this period we're looking at here from 2000 to 2021. So it depends a whole lot on how old you are when you retire, but this is something we talk in great length with our Live Well plan. How much do we want to take out from the investment portfolio? And we study the pension versus the lump sum, some of the pros and cons listed, questions to consider on the screen here, but we have a bona fide process to help you walk through each of these options for your family. And there's really not a right or a wrong answer when doing this. A big piece of this decision is, what is your outlook for interest rates? What is your outlook for inflation? And that is a big part of it, but not the whole thing. Do we have legacy goals? Do we want the next generation to potentially inherit money? A handful of factors to consider, both with pros and both with cons. So we do this for a lot of the large integrated oil companies, some of the utility providers, go down the list. We're very familiar with a lot of the company pension plans of companies that are based here in Houston. Are you retiring before 59 and a half? And we've actually had quite a few clients retire before 59 and a half in the past year. Don't have a good reason of why that is, but we've had this conversation, I'd say, a lot more in the last 12 months than we have over the past few years. Making a one-time distribution, there's a code section within the tax law, 72T, which stands for systematic payments. What that means is you can take funds out of your IRA before 59 and a half without a penalty, but you have to do it for the greater of 5 years or until you reach 59 and a half. Net unrealized appreciation, that's if you have some low cost basis stock, company stock within your 401k. Vocational income, we do see a lot of clients that do retire before this magical 59 and a half number end up getting some type of part-time job that it is more kind of, it makes them, it fulfills a desire of their heart, not necessarily just for the money, or using obviously after-tax dollars to bridge that gap. And then less than 1 year out, we think you should also be really paying attention to what type of stocks do you own? What will your investment strategy look like? And here we think dividend stocks are one of the answers for a successful retirement. You look back here over all the decades, you can see the blue part, dividends account for 40% of the total return of the stock market, dating back to the 40s. So, excuse me, dating back to the 30s. So this is a material number. More importantly, though, income in retirement is we think the key to success. And so having all parts of your investment portfolio producing income is something that we talk at length about. And dividend stocks are a great way to do just that in retirement. We say safe bonds, safe quote unquote, as you can see, But there's been different periods in history, and these numbers that we're using, these are real returns. Real means they are adjusted for inflation. And last year was one of the worst years for a balanced investor meaning part stocks, part bonds, on record dating back to the 70s. And historically, when stocks do well, bonds do not do as well. When bonds do well, stocks are underperforming. But last year you had both stocks and bonds do poorly. If you look back at history, interest rates tend to work in anywhere from a 25 to a 40-year cycle. And so from the early 80s up until really the end of 21, early 22, you saw interest rates moving lower. And we think we could be in another 25 to 40-year cycle where interest rates don't go straight up, but they don't move down. And bring you back to your childhood playground, it kind of works like that seesaw: interest rates up, bond prices down. So we think there could be a potential headwind as bond investors. And what does that look like? How do we produce income without taking interest rate risk? Right now, cash yields are high, but we don't think they stay that way forever. We think you need to be more nimble, more flexible, and consider using some different types of strategies that maybe you haven't considered for the non-stock piece of your portfolio as you do approach retirement. Another thing for consideration within 1 year: investing without a process. And so this gray line here is the S&P 500, the overall stock market. And what you can see in these two red boxes are the times of which people sold the most mutual funds and ETFs related to stock investments. And it's no coincidence that the two times that the selling was the greatest was when the stock market was on sale. This is at the end of 2002, after 3 years of negative years in the market. This is 2008, 2009. We all remember that clearly. So arguably, those are the two best times to actually buy stocks, but that's when most people ended up selling stocks, which is we think you need a bona fide process in retirement as it pertains to what you own and why you own it. But discipline, income generation are two of the core principles for our process. Our goal is to preserve client assets while generating income to meet their needs with confidence. So let's flip over to planning after retirement. What does that look like? We think you need to stress test your portfolio. Let's say you're taking 4% out of your portfolio per year to live on, and your portfolio sustains a 20% loss. So stocks are down, bonds are down, a combination of both, but your portfolio is down 20%. You actually would need a 36% rate of return just to get back to break even. And so what we think is prudent advice is we need to win by not losing in retirement. We need to make sure that our risk profile, the amount of risk we're taking, is appropriate. And the way we get there is by just not stubbing our toe as often. So I'm not saying that our client portfolios are never down, but our goal is for client portfolios to be down less than the overall markets in a downturn. We just want the roller coaster ride to be a lot smoother. And that's for two reasons. Number one, it's much easier to recover from a, call it 10% loss than a 20% loss. But also when you're taking money out of the portfolio, the mentality changes, and most all clients in retirement are more into preservation of capital than trying to grow money for the next generation. So we also wanted to include just a few planning ideas. This is not a comprehensive or a holistic list, but these are just a few as it pertains to some with giving. The second, they're qualified charitable distribution, giving funds directly from your IRA. Once you reach the age 70 and a half, giving appreciated stock in lieu of cash is a way to sidestep some potential capital gains. Where are you taking distributions from? This is a big question to have answered. And it's usually, there's sometimes a great variation in answers in your first year of retirement and your second year of retirement, depending on the month of which you retired. But do you need to withdraw IRA assets before your required minimum distributions? We think it's a high honor in this country to pay tax at 10 and 12%. And so even if you don't have an RMD, required minimum distribution, we will a lot of times recommend taking IRA distributions just to fully utilize that 12% marginal tax bracket. And we're not trying to outperform some arbitrary index. What we do for each family is we create a personalized benchmark for your goals, and that's how we track your progress. Are we ahead of track? Are we behind track? Are we right on track? And it's peculiar and different for every family. So once again, we'd love to create a live well plan for you. Randy sometimes thinks he's an old Baptist pastor. He talks about the 3 C's: comfort, confidence, and clarity. But that's our goal with our live well plan. We want to provide the 3 C's as it pertains to your retirement future. So this is the price group. That's Randy. I'm Matt, Maddie, the redhead, Tiffany, and Melissa. And we are certainly appreciative of your time this morning. If you do have any questions, please feel free to reach out. And we look forward to hopefully talking to each of you soon. Thank you.